Hello and welcome to part 2 of our presentation on superannuation changes proposed in the 2016 federal budget. My name is Justin Chilmy, a financial advisor at Devon Partners Financial Planning. Before we start on the content of the budget, let's just put some things into perspective. The budget proposals are still just that, proposals. They will not become law until they are introduced to and passed by both houses of federal parliament. With a looming election, there is uncertainty in relation to these proposals. Some proposals still have many finer points that need to be clarified regarding their implementation. And as always, the information in this presentation is for general information and education purposes only. It is important that you speak to your financial planner about your specific situation and where potential risks and opportunities may lie. Superannuation changes to contributions. In part 2, we look at introduction of a lifetime cap for non-concessional contributions, uniform concessional contribution cap, the catch-up concessional contributions, the transfer balance cap for pensions, and removing some tax exemptions for transition to retirement income streams. There is a significant change to contributions a person can make to superannuation. Before we get into these proposals, let's just take a quick look at the types of contributions you can make to super. Firstly, non-concessional contributions, which include personal and spouse contributions for which no tax deduction is claimed. They're not taxed upon entry into super and form part of the tax-free component. Concessional contributions are those in which they are generally taxed at 15% upon entry to super, which include employer contributions, voluntary salary sacrifice contributions, and even personal contributions for which a tax deduction is claimed by self-employed people. Most would see this as the most surprising change, the announcement which proposes an introduction of a lifetime cap for non-concessional contributions. This is the only change which is effective from budget night, so in the short term should probably be the focus, as there is time to consider strategies for the other announcements. In addition to being effective from budget night, it applies to all non-concessional contributions made since the 1st of July 2007, as this was the commencement date of the current simple super system, so it is effectively a retrospective measure. For clients who have already made a non-concessional contribution of $500,000 or more since 1 July 2007, there is no penalty, but they will never again be able to make a non-concessional contribution. For excess contributions made after budget night, it appears that the existing framework for excess contribution breaches would apply, which includes some punitive tax measures. In terms of client impacts, this naturally reduces an ability for an individual to make non-concessional contributions. In particular, as last-minute $180,000 or $540,000 contributions would appear to be a thing of the past, this makes starting early on your concessional contributions all the more important. The other change to contributions surrounds the introduction of a uniform concessional contribution cap. For many, this is just as, if not more important than the changes to the non-concessional contributions. Proposed to take effect from 1 July 2017, this concessional cap will be reduced to $25,000 per financial year regardless of age. This current financial year and the next financial year 2016-17, the higher caps will remain in place. Naturally, this significantly reduces the ability to make concessional contributions after the 1st of July 2017. This is particularly relevant to those over 50 who may have been planning to significantly increase contributions in the run home to retirement. Again, this increases the importance of starting early, and for the 2015-16 and 2016-17 financial years, it is time to make the most of it while you can. On the positive front for contributions, there is a catch-up provision proposed for concessional contributions from 1 July 2017, which will allow clients who have not reached their concessional contribution cap in previous years to catch up. However, to be eligible, you must have a superannuation balance below $500,000, and you can only carry forward unused amounts for rolling 5-year periods. And as it accrues from 1 July 2017 onwards, it would appear that the higher limits available this financial year and next will not be carried forward. The positive change will really suit those with a break in employment, especially those who take a few years off to raise a family. Before we look at the proposed transfer balance cap for pensions, we will quickly review the phases of super which impact this proposal. Firstly, you have the accumulation phase. For most, this is a period while we are working and accumulating superannuation. Then we have the pension phase, which for many Australians are using to pay themselves a wage in retirement. The budget introduced a new name for what is basically an old concept, the transfer balance cap, which will have a high impact change on those receiving a benefit in retirement. Proposed to take effect from 1 July 2017 with no grandfathering, there will be a limit to $1.6 million to transfer into a pension account in retirement. The operation appears quite complicated, but with your pension assets of greater than $1.6 million, action must be taken for existing pensioners before the 1st July 2017 also. Aside from the action which needs to be taken to stay under the cap, it will appear to remain a tax-effective retirement income strategy for those with balances above this limit. What could be a big strategy impact? Transition to retirement pensions have not been banned. The proposal, again with no grandfathering, will introduce 15% tax on earnings on transition to retirement pension earnings compared to the 0% currently. This does not change the tax treatment on pension payments. Whilst it reduces the appeal of transition to retirement pensions, it would still appear to remain a tax-effective superannuation savings strategy. Thanks for listening to part 2 of our federal budget update on superannuation changes. We trust you found this information useful. If you've not already, look for part 1 that addresses the other superannuation proposals from the federal budget. If you have any questions or would like to know more about Devon Partners and our services, you can visit our website or by searching for Devon Partners on Facebook. As stated earlier, the presentation is for general information and education purposes only. A conversation with your financial planner is important to ascertain how your specific situation may be impacted and the potential opportunities available. Thanks for listening.